Profit of over 50% in Brazil and yet no spot business? Whoa, is the issue we're going to discuss with Mike Zuzolo, and yet the energy market right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. So, Mike, we are going to discuss many issues today. We are going to talk about these market deals in Brazil and yet the energy market. But let's start with U.S. weather. The rainfall that was expected to come didn't fall in your areas of the Midwest.
No, and we continue to see the same pattern that we've had pretty much since May, Luis, where areas that are supposed to get rain are not getting as much as forecast, and then areas that are supposed to get adequate rain are getting too much. And I've actually heard from more producers this week about too much rain negatively impacting their crop yields as opposed to producers who haven't gotten enough rain. And I think there's two reasons for that. One, I think the area of a lack of rain is shrinking. Areas of Kansas, areas of Nebraska, some areas of Iowa are finding better precipitation totals, and their crops have come around very nicely, in part because we haven't gotten too hot in the last 2 or 3 weeks. So there's been hot waves, but it hasn't lasted long. And we've had mostly cool evenings as well. So that's been very beneficial for the corn, especially. I think the second reason is because the clients that are calling in with too much rain right now are really calling in the aspect of the soybeans. The beans in this country, as we've talked about, are very short for this time of year for the most part. And as a result of that, extreme dry or extreme wet weather has been hampering their growth. And I think that's been the biggest reason, two biggest reasons why those clients have been calling in. And I'm actually going to take a crop tour on Friday. I'll be leaving the office Friday morning and driving to the Indiana-Illinois border. Over the weekend, I'll be taking a northerly route on the way east, and then I'll be coming back through St. Louis as I head back west and head back through Kansas City. And so I'm eager to see this because the area that I'm going to be traveling is some of the best farm ground that I've been hearing about, but also intermixed with this is some of the excess rainfall too. This is the area of the country I believe is going to make or break our yield estimates, and it's going to essentially make or break USDA's yield of 179.5 and 50.9 bushels per acre nationally, especially after crop conditions came out yesterday.
Yes, and as we speak, the price for a bag of 60 kilograms of corn in Brazil is nearly $25, but that in the local currency reaches 100 reais. And that means a lot of profits, but it's still, given the future contracts, farmers are not selling right now because they are afraid that they will not have enough corn to sell after harvest because of previously committed grain. So, what do you think are the opportunities here for the U.S. farmers and traders?
Yeah, it's a really good question because 2 points there as well. I think at the end of last week, we had this idea going home for the weekend that while the weather was starting to shape up hotter and drier, it wasn't as hot and dry as when we came back on Sunday night. But we did have the news coming out of Brazil that there may be some cancellations of contracts by major end users. And in other words, a type of force de majeure where you can't literally get the corn to sell and export out. And they were pretty large multinational grain companies that we were hearing were not going to be able to ship out corn. And one of the things that bothered me was that with this news, we did not see a sharp increase in the export price of corn out of the Paranagua port, even though in one of the stories I saw on last Friday, they spoke specifically about not being able to get out of the Paranagua port with corn because the second crop corn was so low in production. So there's a disconnect in this market right now. And I think it's really held back the longs in this market when it comes to the futures market at the mercantile exchange. And this goes into my second point, Luis, that is really prescient and very important right now. At the Gulf of Mexico here in the United States, we have a price of about 6.75 to $7.20 a bushel, depending on how you factor in where it's at and what type of freight you're talking about. In the interior of this country, the cash price of corn is also between $6.50 a bushel to $6.80 a bushel, generally speaking. So how can you have essentially 6.50 to $7.20 corn in the cash market around the United States, including the Gulf of Mexico, and only have $5.70 futures prices? This is a very big disconnect. I don't think we've seen a disconnect like this since the mid 90s, if memory serves me right, like the 1995, 1996 market. I remember that kind of a spread disconnect and futures cash disconnect at that time period. And I think this is really important because one of those two prices is right. We just don't know which one it is because the data is not lining up yet. So that's the demand side of the equation and the supply side, because you haven't seen a lot of end users come and buy a lot of US corn. They haven't felt pressed to buy a lot of US corn because the Brazilian price hasn't skyrocketed higher on tighter supplies. And so this, I think, is what's really bottled up the corn market and has held it back.
And what people are commenting here in the market is that either in August or September, Argentina is going to flood the Brazilian market with corn.
Yeah, and that's a really good point. And I think that's something that I think that maybe is holding back the end users as well, along with the fact that they still have had quite a bit of wheat purchases that are probably on the water right now. And those wheat purchases were substituting out corn. So I do think that the USDA report set up a market condition where the wheat is no longer a negative force in this market for the next 4 to 5 months. I also feel as though the report and the weather have set up where the soybeans are no longer a negative force on the market for the next 2 to 3 months, unless we do break this ridge down prematurely, this ridge of high pressure prematurely here in this country in the next week or two. So the downside, maybe we're not getting the upside potential in the futures market we want in the corn and to a lesser degree the soybeans, but I think the downside is minimized because of some of these new fundamental factors, and in no small part due to the weather. I have to say, when I looked at the crop conditions report yesterday, I am very disappointed with the spring wheat close here on Tuesday as we record this, because the spring wheat closed lower, even though the very poor conditions shot up 8 percentage points in 1 week, and they're now at 63% very poor for the United States spring wheat crop. And so I would say it is too late for the spring wheat crop. Losses of 25, 50%, maybe even more, are now starting to be expected by producers in those areas. And so my question to myself is, why can't spring wheat rally any more than it already has, given these fundamentals? And I think it really goes back to those outside markets.
Yes, if the U.S. corn does not go to Brazil, well, somebody will have to supply China.
Yes, and I think this is where the Chinese wheat price on the futures market and the Chinese corn price on the futures market is still 2 to 3 times the price of U.S. corn futures, and in both corn and wheat. And so, and even the cash wheat market is substantially higher in China than it is here in the United States. And we're wrapping up harvest. And what we had talked about, you and I, about maybe the hard red wheat harvest in areas not far from me. While the yields were very good, they weren't as good as I don't think the farmers and the marketers were expecting them to be. So I think that's another element of this puzzle that we're going to have to keep a close eye on. And all these things we're talking about right now, Luis, whether it's COVID and the outside markets, or whether it's the weather, or whether it's Brazil and Argentina's corn, I see these things unfolding very similarly as you do. I mean, August and September is only 1 to 2 months away. So I think there's going to have to be some answers here, I think, in the very short term.
Yes, and by comparison, how is profitability for both corn and soybeans in the US?
Well, I think this is where there are the haves and the have-nots, and I'm still on the side that we are not at a 179.5 national yield in corn, nor are we at a 50.9 yield in soybeans. I think we are able. I think we're at 175 plus in the corn, and I think we're trying to get to 50 bushels in the beans, but I don't think I could go much higher than that. But that's a big reason why I'm taking this crop tour at the end of this week, because we're pollinated here in this part of the country. It looks exceptionally good. Nebraska clients that were looking rough about 2 or 3 weeks ago are looking very, very good now because of the rains that they had and the cooler weather that they had. And one client in Nebraska told me this morning that one of the best things that's happened is a lot of the plantings in the state of Nebraska, and I'd say our state of Kansas as well, was that it was done early enough. Even though it was cold, it was done early enough that it's going to miss a lot of the hot, dry weather and be able to get pollinated okay. Now, that if not very, very good. Now, that doesn't answer the question of how good of ear fill we have, but pollination doesn't look as significant in the Western Corn Belt as maybe it did 2 weeks ago. So I think the yields are average to above average here in the United States, but I can't give them much more than that, especially before this trip.
Yes, I want to jump into the other commodities and the relationship with the energy prices. So we were commenting last week about the crude oil price, and both the Brent oil and the West Texas Intermediate oil have fell uh, during the last days. And why do you think is that? And do you think this is going to have an impact on agricultural commodities?
Yeah, I do. I think it will, and it will continue to. I feel as though this is one of the best examples of why I look at macro fundamentals along with supply demand fundamentals when it comes to agriculture commodities, because to oversimplify this market, but to explain it very, very well, I think in the early part of this week, is you had this ridge of high pressure that should have given us 30, 40 cent moves up in the corn and beans, given what we heard about Brazil at the end of the week, in my opinion. What instead what we saw was a sharply lower market on Monday, and I think you can put that directly at the feet of the idea that the emerging markets are getting nervous about COVID again. The emerging markets help control what the dollar does, and that dollar helps control what the crude oil does. And when the dollar started to shoot higher, and we're running, at almost 3 month highs now in the dollar index, as you and I talked this week, we have seen the emerging markets and we've seen the crude oil fall in an opposite price path as what we've seen the currencies do. And this, I think, goes back to the fundamentals of the investment flows, suggesting in their minds that the COVID lockdowns are going to increase and it's going to hurt demand as much as the supply is being hurt by the weather in the agriculture commodities. And so I see this as very linear, that the dollar and the emerging markets are in control in the short term, at least, and that has controlled the energy markets. The energy markets then flow through into the other commodities, including agriculture, because of soy oil and because of ethanol. And you noticed Monday, soybean oil was one of the hardest hit assets in the agriculture sector. And I think it's direct linkage there between the energy and the soybean oil for the biodiesel. So that's how I see this market. And this really explains pretty well, Luis, why I really want to sell when the market goes higher, because this market is not a demand-led market. It's a weather supply-driven market. And that's why the emerging markets are weak and why they're nervous and why the dollar is finding support. So people that, and there's a lot less of this talk now, but people that are talking $8 corn, $9 corn, you'd have to have something on the lines of what's going on in the spring wheat complex to have happen here in the United States. In other words, Minnesota, North Dakota, and South Dakota end up being about 18 to 20 million acres of corn and bean planting. So those three states are substantial, and they end up being 20 to 23% of the acreage planted here in this country. So if we saw those three states take the same path or the same route as what the spring wheat is doing in terms of crop conditions, then I can make a very good case for $8 corn. But other than that, again, that's supply and weather. It's not demand.
Yes, to give you an idea, that dollar rally happened in most countries in South America. In Argentina is a bit a different world because we have currency controls, but there is a blue market where the dollar also appreciated.
Yeah, and if correct me if I'm wrong, I was going to ask you this. I'm glad you brought it up, but we do know there is a black market inflation number in Argentina, and if memory serves me right, it's getting up there around 70, 80%. Is that what you're hearing, or is it not as high as that?
Well, inflation got nearly 50%
And that's
in
the
the
official
last,
number.
yeah, in the last year.
But if you look at the black market currency, I think it's 20 or 30% higher than that right now.
Yes, and that is important because if you look at the total Argentinian corn production, is it can be like a state of Nebraska, but if you look at the exports, they have a significant portion of exports in the world.
Yeah, that's a really valid point. And as we know, Argentina is the world's number one soy meal exporter as well. And I think that's one of the biggest reasons why the soybeans haven't been able to go to price levels that some of the traders thought it could go to, because it's been a soybean oil led rally, not a soybean meal led rally. And I think this revolves back around to African swine fever and the ample soybean supplies in Argentina and even Brazil, but Argentina especially when it comes to the export market. I am watching soy meal very closely though. I've got some technical buy signals that are shaping up, and the crush margins here in the United States are back to about $1 a bushel. So I think the meal has a little bit more supportive features to it than it did in the last 3 or 4 months when it comes to the soybean complex.
And within the meat markets, are you still more bullish about the lean hogs?
Yeah, I am. I mean, I think that's where the weekly export sales were disappointing last week for both pork and beef, down quite a few percentage points versus the 4 week average. But I still think, and the Chinese Ag Ministry came out this week and talked about their African swine fever and said it was tough going. They said they haven't had any new cases, but the conditions are still very ripe for new cases. And when I saw that Germany this week also has now African swine fever in one of its commercial herds, I think the support in the pork sector is there from a standpoint of limited supplies to compete with the United States at this stage. And 3 months down the road, maybe we won't be able to say that. But in the very short term, I think this pork has got some support, especially with it falling back towards the 105, 108 level. It's not at 120, $130 anymore. So it's fallen back. That pork and bean trade continues to trade very, very strongly with one another. The soybeans and the hogs are tending to go in the same direction still, and that indicates to me the funds are still keeping those connected.
Yes, and you've been more bearish about the beef cattle.
Yeah, I have been, especially the feeders, because of the premium and the feeder futures. I still feel that way as long as we still have a drought in the corn market. Luis, I think one of the things, what I've talked about with clients that maybe is a little bit different than the last time we talked when it comes to the fat cattle, is that in the very short term, I would like to see the fat cattle rally another couple dollars in that August fat cattle market get up to around $124. That's my overvalue level that I want to hedge. I want to hedge it aggressively because I'm really nervous that not only in the northern plains, but also in the Canadian prairies, and then as you go west through Montana, Idaho, Washington, Oregon, all these states are cattle states, and Canada, obviously, in the prairies are very strong cattlemen too and ranchers. So I think we're really setting ourselves up for a liquidation phase of some cattle in the north that could impact the whole country's prices. And so I would stick with the idea that August, September are more nervous markets. The COVID reasserting itself makes me feel like I'm on the right track by wanting to get hedges on as well. So I want to get through the liquidation and the planes and the COVID for the fall and late summertime period. And then we'll see if the supplies are tight enough. We can just stay current in the cash markets.
And we look forward to hear next week about your crop tour.
Thanks for having me, Luis. Look forward to it.